Hi there, my name is Jeff Gilbert. You are about to watch part one of a multi-part series that looks into the real estate market in Simcoe County. Part one specifically looks at 2017, which ended up to be a historic year for real estate in Southern Ontario. This part one of this multi-part series is brought to you by Strategic Real Estate Investments. All right, so as mentioned, 2017 was a monumental year for real estate in Southern Ontario. The focus of this report will be specifically the Barrie and Aurelia areas, but it will also include data from the surrounding municipalities. So this is what we're going to cover. What exactly happened to trigger this huge surge in market appreciation? We're even going to go back to 2015 and show you the build-up. We're going to touch on the bubble, what a bubble is, and why did it burst, and what happened to kind of bring things back into perspective. And then we're going to look at the life after the bubble burst. All right. So what exactly happened? So what we're looking at here is this blue line represents the median sales price. The green lines in here represent the number of active listings. So I want you guys to all notice the relationship of these two figures. As one goes up, the other one's going down. So this is your supply-demand factors. So this data here is going all the way back to January 2013. But you can just kind of see how this line goes. And as we get into January 2017, you can see this surge here, this massive spike here in increase in the median sales price. That's corresponded with a huge decrease in active listings. So inventory was, I guess you want to call it, your supply was at all-time lows, and the demand was at all-time high, which I guess supply-demand 101, you're going to see a massive surge in prices, and that's exactly what we saw. So this chart here is just going to show you a little bit of the inventory levels. This happens to be actually my favorite stat when trying to identify market trends and what type of market we're in. It's called the months of inventory stat. So basically what we do to find this number is we're going to go back usually in a 12-month period, and we want to find out on average how many unit sales are happening each and every month. So if we can get that average of how many sales there are, we can then divide that into the number of active listings to determine how many months it would take to sell off all the current inventory. So obviously higher numbers represent more inventory. Lower numbers represent lower inventory. So I would say a balanced market would be somewhere around 3.5 to 4. That would be considered balanced. So this chart here goes back to 2013. And you can see that this is kind of here where we kind of have been. So we're just more kind of lenient on the seller side. But you can see as we kind of headed into 2016 and obviously to the peak of January 2017, you can see that this months of inventory stat actually fell below 1 month, meaning that if no other properties came on the market, if we kept selling properties at the same rate that we were selling properties, it would take almost 2 weeks to sell all of the properties off. So all of the properties would be gone. So demand was just off the charts. And this obviously right in here corresponds with when we seen the massive surge. And then you can fast forward here and you can see how these inventory levels just dramatically increased all of a sudden come around mid-year or so. And then they dip back down, and then you can see this is where current day levels are. So here's just some numbers if you want to actually kind of see the data that's making up that chart. So you can see these are just they're rough figures. Usually when I do it, I get a little bit more precise with to the decimal point, which actually can make a massive difference to this, but this will give you a general idea. You can see the 10-year average is 2.26 months. And if we go here to 2017, you can see how in February we're 0. And then, so these 4 months here, with 1, 0, 1, 1, and fast forward to June where we spiked up to 5 months. And near the end of the year, we actually got back down into more close with the 10-year average. So just to kind of further kind of show, I guess I wanted to really kind of show you, this is a chart that we made to kind of show you, give you an idea of how inflated the prices got. So this chart goes all the way back to 2008. What I was trying to accomplish here was to do a trend line of where we started to kind of where we got to. So if you can see, if we draw this straight line, you can see we're going along quite nicely here, and then all of a sudden right here, January 2016 is where I'm identifying really the start of this this surge in prices and the bubble. Really, you can see how quickly we jumped across above this line to obviously the peak here in February, March, April of 2017, followed by this sharp decline. So from this perspective, you can still see as we move into January 2018, according to this trend line, you could still consider prices to be slightly overvalued if we were kind of putting it on a straight line approach dating back to about 10 years. So here's some quick numbers to just give you an idea of what we were actually dealing with. So you can see January 2016, this again is where I identified the start of the bubble. So in January 2016, our median sales price at the time was $348,000. Fast forward to the peak of the market in April of 2017, where the median price was $535,000. So in that short year and a half time, the market had increased 53.7%, which is really just, there's no other word other than insanity. That's insane. So you can see from January 2017 to the same market peak, so literally in 4 months, we appreciated nearly 16%, which is also insane. Then the overall big picture, from that surge, you can see January 2017, we started with an opening median sale price of $462,500, and we ended in December of 2017 at $442,500, which actually amounts to a 4.3% decrease in price. So 2017, everyone's going to remember the massive surge in prices and price increase and appreciation, but at the end of the day, when she's all said and done, the market actually decreased in value 4.3%. And from the peak in April to the end of the year, we actually seen a 17.3% decrease. So I think we clearly identified that we are experiencing a bubble. I found this definition of a bubble, and I find it to be rather representative of what it is. So for those that are perhaps listening, I'll read it. It says, if the reason that the price is high today is only because investors believe that the selling price will be high tomorrow, and when fundamental factors do not seem to justify such a price, then a bubble exists. And I think that's exactly what we saw. The fundamental factors, meaning mortgage rates and rentability of these properties, just was not there. Prices were inflated, and it was almost just a race to try and get something because the market was just going insane. And unfortunately, people that bought in the peak have since probably paid a little bit more for their property than what it would be worth today. So here's just I guess a shameless endorsement, if you want to call it. But back in the beginning of 2017, we actually published a forecast where we were looking ahead to 2017, and we wanted to see, much like we're doing here, not particularly with this one, but what you'll see with part 2 is a forecast. So back at the beginning of 2017 in January, so you can see I was talking about the bubble here, and I kind of stated that bubbles, when they burst, often come back to where they started, and which in our case could represent a considerable correction in prices. And I kind of came down here and said, let's be modest and plan ahead. We could roughly see about a 14% pullback in the price from the peak, which if we actually go back a slide, you can kind of see I was rather close. So we actually came back 17%. I estimated 14, but I said modest. So I know, shameless endorsement, but so here you go. This just shows you from the start. This, I guess, going back to if you look at this here and the definition of a bubble, this is your classic definition of the ultimate bubble and burst. And if we come forward, you can see this is the median sales price. You can see the massive climb and then the burst. And we kind of came back right to where we are. Again, corresponded with the number of active listings. You can see how that's up and how the active listings are down compared to all of a sudden where we had a massive increase in listings with a sharp decrease in price. All right, so why did this happen? Why? So the first thing that we'd like to point out is when the Ontario government stepped in and intervened. So they introduced the Ontario Fair Housing Plan. This was in April of 2017 when the market was just at its, I guess, peak insanity. So the main points to take a look at here is the non-resident speculation tax. So they imposed a 15% tax for non-residents purchasers buying property, basically foreign investors buying property based off of speculation here in Southern Ontario. They also wanted to try and increase the supply of affordable homes. They wanted to protect renters, as we've seen with the standard lease that was just released actually at the end of last month. And they put complete rent control in place. They also empowered local municipalities to move forward with vacant home taxes, stuff like that, to try and promote added supply. They identified that we were at a supply issue and the demand was there, so these were all initiatives to try and increase supply of land. So more than anything, it's our belief that this dramatic change really, more than anything, I guess through media and everything else, I think it just really affected the consumer confidence surrounding the real estate market, which people kind of stood back and said, okay, yes, we do have an issue here. And a lot of people just kind of pulled back and they wanted to see what was going to happen. The other obvious issue was that it seemed in May and June that, I wrote here, everybody, their brother, sister, aunts, uncles, third cousins, everybody tried to take advantage of the fruitful benefits that the heavily favored sellers market was providing people. So you can see their active listings here in March being extremely low to all of a sudden a massive surge where just everybody, so we just had a flood of new listings. Meanwhile, consumer confidence had declined with the government intervention, and we just seen that was the end of it. That was clearly the end of it. So you can see this is kind of the life after the bubble did burst. So this gray line that you're seeing here, this is the ratio of listings to sales. So you can see during the peak, we were actually selling we got over 200%. So we were selling more listings than we even had active listings. And compared to now, where I would say the 10-year average would hover around the 50% mark. And that's currently kind of where we are sitting at here. So this really actually just equates to a healthy market. And you can see we're down here a little bit, which was not as healthy. When you see a sharp decline here, that's when you're going to see not as many unit sales. So we want to be in this area, and that's actually where we ended the year. So further to that, what we did is we went back 10 years. We wanted to find the 10-year average for the number of active listings per month in relation to the number of sales. And we wanted to kind of see how each individual month for the year of 2017 stacked up. So we did a little color code here, so it's a little bit easier for you to follow along, because I'm sure just looking at this for the first time, you're probably like, what the heck? And I get it. So, so any of these numbers here in the dark red, they're going to be way below the 10-year average. Anything that's dark green, like in here and in here, this is way above the 10-year average. And anything that's yellow is balanced. That's right on trend with the 10-year average. So you can see for the number of active listings for January, February, March, we were way, way, way below the 10-year average. So normally in January, we would see 382 active listings. In January of 2017, we only had 111 active listings. Compare that with actually the number of unit sales. So the 10-year average is 134 sales in the month of January, and we had 130. So we were right on average. We were balanced with the number of sales. However, we were just way under for the number of active listings, and there you can see the listing to sales ratio. So fast forward, I know that you can probably see this, and if you want to look in more depth, just pause the video for a couple minutes, and you can relate all of these numbers here to the active listings, and all of the sales numbers to the number of sales. But I do want to touch on June. So June here, we had 979 active listings, when the 10-year average is only 608 active listings. Mind you, that is, well, between May and June, the highest, I guess, months according to the 10-year average for the number of active listings. And you can see how high above that we actually were. And so you compound that with a below average number of sales, and you get a 21%. So basically what that 21% means that 21% of these 980 listings actually sold, when normally we'd want to see that number around 50%. So you can see we actually ended the year off getting a little bit closer to a healthy market, but still a little bit under. So we were just a little bit above average in active listings, and slightly above in unit sales in the month of December. So really, really interesting and telling chart here. So what about the prices? So you can see this is the price line. We already kind of touched on this, but you can see the start of 2017 being here and the end of 2017 here. And if I draw this line, you can see this downward trend. And if you remember, we actually reduced, I believe it was 4.3%. So there you go. This is just a little bit easier to follow than the previous chart, but you can see, so from January here to the peak in April, we increased 15.7%, and from April to December, so the peak of the market, to the actual year end, we declined 17.3%. And then overall from January till December, we decreased 4.3%. There she is again. I promise that's the last time. Shameless, I know, but I think it's pretty cool, and that's why I want to, when you do forecast something like this and you get somewhat close to being right, you feel a little bit proud. So I guess I'll just, but I promise that's the last time. All right, so that's going to conclude our look back at 2017. I just wanted to give you a taste of what we were working on and the value that you're going to get from these videos. In part 2, we're going to take a closer look at how the first quarter of 2018 ended up, and then we're also going to forecast or predict what we think the real estate market's going to do as we round out 2018 and move into 2019. So if you haven't yet, make sure to sign up for that video, because you must be a subscriber to view that one. This one we just kind of threw out there, but in order to see our 2018 forecast in part 2 of the 3-part series, you must sign up. So just to let you know what part 3 is, so part 3, we actually look back at our top 5 investments of 2017. So this would be the top 5 properties that we ran analysis on, that we felt were the best 5 purchases made in 2017. So you'll also be able to access that through a subscription to part 2. And obviously, if you sign up for that, you can also indicate if you want to get on our weekly deals emails. So basically what we do is we search through on and off market properties, all investment opportunities. We bring you our top picks for the week. We break down the numbers. We show you the forecasted cash flow and the potential return on investment. It's pretty slick. Our current subscribers seem to like it, and we're going to continue doing that. So if you are potentially in the market or always on the lookout for a good investment opportunity, this is something you're going to want to be a part of. So again, with signing up with that to get part 2, you also get signed up to receive this. All right, so as I mentioned, that concludes part 1 of this multi-part, 3-part series. So again, this was brought to you by Strategic Real Estate Investments. My name is Jeff Gilbert. I'm a sales representative with Century 21 BJ Roth Realty. And these are the other members of the team. We also manage properties in the area. And so we have a real good understanding of the rents. So if you have any questions about that or anything else contained in this video, feel free to reach out. There's the contact info. And I will see you in part 2.